Something just happened in the silver market that cannot be undone. On current delivery month, 1,624 futures contracts stood for physical delivery instead of rolling forward. If you don't trade futures, that number means nothing to you. But if you understand what just occurred, you're watching the moment the squeeze moved from theory to mathematics. 1,624 contracts. Each one represents 5,000 ounces of silver. That's 8,120,000 ounces of physical metal being demanded from the COMEX vaults right now. Not next month, not next quarter. Now. And here's why that number should terrify anyone short this market. The COMEX registered inventory, the metal actually available for delivery, sits at roughly 28 million ounces. You're looking at a single delivery month consuming nearly 30% of available supply. That's not a trade, that's a siege. But the number itself isn't the story. The story is what the number represents. It's called backward rolling, and it only happens when the market is screaming one thing. We want the metal more than we want the contract. In a normal market, futures traders roll their positions forward. They don't want delivery, they want exposure, leverage, price action. They're playing the paper game. But when contracts stand for delivery instead of rolling, you're watching the paper game end. You're watching someone say, I don't trust your price, I don't trust your market, give me the metal. Backwardation is the technical term. It means the spot price is higher than the futures price. It means immediate demand is overpowering future supply expectations, and it's not supposed to happen in silver. Silver is an industrial metal with steady production, established supply chains, and deep inventories. When silver goes into sustained backwardation, it's not a price signal. It's a structural break. Let me show you what I mean. In 2020, during the initial COVID panic, silver briefly spiked into backwardation as supply chains collapsed. The premium on physical silver exploded to $8 to $10 over spot. Dealers ran out of inventory. Mints couldn't keep up. And that was with COMEX functioning normally, with no delivery stress, with producers still mining. That was a logistics crisis. What we're seeing now is different. This isn't a supply chain problem. This is a supply problem. 1,624 contracts standing for delivery in a single month isn't panic buying. It's not retail FOMO. Retail doesn't play the futures market at scale. Retail does not have the capital to post margin on 1,624 contracts. That's over $40 million in margin requirements at current levels. This is institutional. This is strategic. This is someone who planned this move, sized the position, and executed with precision. And when you ask yourself who that someone is, there's only one entity that makes sense: China. Now, before you roll your eyes and think this is another China buying everything narrative, let me walk you through why this is different. China isn't buying silver for the same reason hedge funds buy silver. Hedge funds buy for portfolio diversification, inflation hedging, dollar weakness plays. China buys silver because they need it, physically need it. And they need it in quantities that dwarf every other industrial consumer on the planet. Here's the framework. China controls over 80% of global solar panel manufacturing. Every single panel requires silver paste as the conductive element that turns sunlight into electricity. There is no substitute. Copper doesn't work. Aluminum doesn't work. The photovoltaic cell requires silver's unique electrical properties. And China isn't building solar panels for export anymore. They're building them for domestic consumption. The Chinese government has mandated massive renewable energy capacity targets as part of their carbon neutrality goals. They're installing solar farms the size of cities. And every megawatt of capacity requires silver. But it's not just solar. China is also the largest EV manufacturer in the world. Every EV uses twice as much silver as a traditional internal combustion vehicle. The average EV contains 25-50 grams of silver in the electrical components, battery management systems, and charging infrastructure. China produced over 9 million EVs last year. That's 225,000 to 450,000 kilograms of silver, 7 to 14 million ounces, just for EV production. And that number is growing at 30% annually. Then add 5G infrastructure. Every 5G base station requires roughly 3 times the silver of a 4G tower due to the increased antenna arrays and signal processing requirements. China is building the world's largest 5G network, over 3 million base stations and counting, each one pulling silver out of global supply permanently. This isn't speculation. This is industrial mathematics. China needs hundreds of millions of ounces of silver annually just to meet their stated infrastructure goals. And they can't get it from domestic production. China mines about 110 million ounces per year, but their industrial consumption is estimated at over 200 million ounces. They're running a structural deficit, which means they have to import. And the cheapest way to import massive quantities of silver without spiking the price is to buy futures contracts on COMEX, take delivery, and drain the Western vaults quietly. And that's exactly what's happening. Over the past 18 months, we've seen a pattern emerge. Large contract positions appear. They don't roll. They stand for delivery. The metal leaves the vault. And the registered inventory ticks down, month after month. This isn't hidden. It's public data on the comex reports. But most people don't track it. Most people don't connect the dots between inventory drawdowns and Chinese industrial demand. Let me give you the numbers that make this undeniable. In January 2023, comex registered silver inventory sat at 68 million ounces. Today, it's at 28 million. That's a 59% drawdown in less than 2 years. And this isn't warehouse shuffling. This is metal leaving the system entirely. Once it's delivered against a futures contract, it goes to the buyer. And if that buyer is a Chinese industrial firm or state entity, that silver is going into solar panels, EVs, and 5G towers. It's not coming back. Now let's overlay that with what just happened. 8.12 million ounces demanded for delivery against a registered inventory of 28 million. That's 29% of available supply in a single delivery month. If this pace continues, if even half this pace continues, the registered inventory hits zero in less than 6 months. You can't run a futures exchange with zero deliverable inventory. The entire mechanism breaks. Here's where it gets interesting. COMEX has 2 categories of silver inventory, registered and eligible. Registered means it's available for delivery right now. Eligible means it's sitting in a COMEX vault but not allocated for delivery. It's someone else's private storage. Total eligible inventory is around 250 million ounces. So the argument you'll hear is, don't worry, there's plenty of silver in eligible. They'll just move it to registered if needed. But that assumes the owners of eligible silver want to sell at current prices. And why would they? If you're holding 10 million ounces in eligible storage and you see registered inventory collapsing, delivery demand spiking, and backwardation appearing, you're not releasing that metal for $75 an ounce. You're waiting. You're watching the registered inventory bleed out. You're letting the squeeze tighten. Because you know what happens when a futures exchange faces a delivery default, force majeure, cash settlement, and panic buying in the physical market that sends prices vertical. This is the game theory that most analysts miss. Eligible inventory is not a relief valve. It's a hostage. The owners of that metal have no obligation to convert it to registered. And the tighter the squeeze gets, the less incentive they have to help. They become spectators watching COMEX burn through registered inventory, while their metal sits idle, appreciating. And China understands this game better than anyone. They've played it in other commodity markets. Look at what they did with rare earth elements. China controlled the supply, let prices stay low for years, encouraged Western mines to close, then tightened export restrictions and watched prices explode. They're patient, they're strategic, and they're doing the exact same thing with silver, except this time, they're using COMEX's own delivery mechanism as the weapon. Here's the beauty of the strategy from China's perspective. By taking delivery through COMEX instead of buying physical in the open market, they get 3 advantages. First, they avoid spiking the spot price prematurely. If China showed up bidding for 8 million ounces on the physical market, premiums would explode immediately. But by using futures contracts, they lock in the price months in advance when they open the position. Second, they drain Western inventory systematically. Every ounce that leaves a COMEX vault is 1 less ounce available to suppress the price through paper manipulation. Third, they create exactly the kind of delivery crisis we're seeing now, one that forces the futures market to confront its own structural shortage. And make no mistake, this is a structural shortage. Global silver mining production peaked in 2016 at around 900 million ounces annually. We're currently at about 830 million ounces. Production is declining because the easy deposits have been mined, or grades are falling, and new discoveries aren't keeping pace with depletion. Meanwhile, industrial demand keeps growing. Solar, EVs, 5G, medical applications. Every major growth sector of the global economy is silver intensive. The deficit between mine supply and industrial demand is estimated at 150 to 200 million ounces annually. That gap is being filled by above-ground stockpiles. And those stockpiles are finite. Investment demand is almost irrelevant to this equation. The real pressure comes from industrial consumption that doesn't recycle. When silver goes into a solar panel, it's embedded in the cell structure. When that panel reaches the end of life in 25-30 years, the silver is molecularly dispersed and uneconomical to recover. It's functionally gone forever. Same with EVs, same with electronics. Industrial silver consumption is one way, and China is consuming at a rate that dwarfs every other nation. So when 1,624 contracts stand for delivery, you're not watching a trade. You're watching the endgame of a multi-year strategy to corner physical silver supply while the Western financial system plays with paper derivatives. And the Western banks are finally realizing they're trapped. Let's talk about the short side of this trade. The commercials, the big bullion banks like JP Morgan, are historically net short silver futures. It's their business model. They sell paper contracts to provide liquidity. hedge their physical operations, and profit from the contango in normal markets. But backwardation breaks that model. When spot is higher than futures, the carry trade goes negative, and when delivery demand spikes, those shorts face a choice: deliver the metal or buy back the contracts at a loss. JP Morgan has physical silver they've been accumulating for years. Estimates suggest they hold between 800 million and 1 billion ounces in private storage, so they can deliver, but every ounce they deliver is an ounce they no longer own. And if they have the same data we're looking at, that this shortage is structural and worsening, why would they deliver metal at 75 stars that could be worth $100 or $150 in 6 months? They wouldn't, unless forced, and that's the trap. If JP Morgan or other shorts refuse to deliver, they trigger a default, force majeure, cash settlement, and that destroys confidence in the entire comex silver contract as a pricing mechanism. The market would bifurcate. Physical would trade at a massive premium over paper, and comex would become irrelevant. But if they do deliver, they're draining their own inventory to satisfy demand from China and other industrial buyers who are not selling the metal back. Either way, the Western banks lose. This is why the backward rolling we're seeing is so significant. It's not just delivery demand, it's the proof that the industrial buyers have decided the paper price is no longer real. They want the metal, they're willing to pay the margin, they're willing to deal with the logistics of taking delivery, and they're not rolling the contracts forward, which means they're not interested in playing the futures game anymore. They're converting paper to physical, and once that conversion reaches critical mass, the paper market loses all credibility. Now, let's talk about what $100 silver actually means in this context. It's not an arbitrary number. It's not a hopeful target. It's the mathematical result of what happens when physical demand overwhelms paper supply. Now, let me show you the math. Current registered comex inventory, 28 million ounces. Monthly delivery demand based on what we just saw, 8 million ounces. If this pace holds, registered inventory reaches 0 in 3.5 months. But it won't hold. It will accelerate. Because as inventory falls, more traders will panic and demand delivery before the vault's empty. And as delivery pressure rises, the premium for physical over paper will explode. Right now, there's roughly a $3 or $5 premium for physical silver coins and bars over spot. That's normal friction. Minting costs, dealer margins, logistics. But when supply gets tight, that premium expands. In 2020, it hit $10. In extreme shortages, it can hit $15, $20. And if comex inventory actually threatens to hit 0, you'll see physical trading at 30 plus over spot because no one will trust paper settlement. When physical premiums spike to $20, $30 over spot, that is the real price. The paper price becomes meaningless, and at that point, arbitrage forces the spot price to catch up. Because if physical is trading at $100 and paper is at $75, every trader in the world will buy paper, demand delivery, and sell physical for an instant $25 profit per ounce. That arbitrage pressure forces convergence. The paper price has to rise to meet the physical price. And that's how you get to $100, not through speculation, through forced reconciliation between paper fiction and physical reality. But there's a second path to $100 that's even more direct, algorithmic buying. If comex silver breaks above 82.67, the recent multi-year high, it triggers a technical breakout that activates trend-following algorithms. CTAs, systematic funds, momentum strategies, these aren't discretionary traders making decisions. They're computers executing predetermined rules. And the rule is simple. If price breaks resistance, go max long. These funds manage trillions in assets. Even a small allocation to silver futures could mean $5 to $10 billion of buy orders hitting the market in a single session. That kind of volume in a market with 28 million ounces of deliverable inventory creates instant shortage panic, prices gap, liquidity disappears, and you get what's called a melt-up, where price moves vertically not because of fundamentals changing, but because the market structure can't absorb the buying pressure. We saw this in nickel in 2022. The London Metal Exchange had a short squeeze where nickel went from $30,000 per ton to $100,000 per ton in 48 hours. They literally had to halt trading and cancel trades because the delivery obligations exceeded available supply. That's the endgame scenario for comex silver if this delivery pressure continues. And once that happens, the price doesn't go back down to where it was, because the entire world just learned that the paper market was a lie. Trust breaks, and physical silver reprices permanently higher. Now let's talk about timing, because this isn't a theoretical scenario playing out over years. This is happening right now with specific deadlines. The delivery month we're watching is current month. Delivery notices have been issued. The metal has to be allocated and transferred by a specific date, typically end of delivery month. That's days or weeks away, not months. And if registered inventory can't satisfy these 1,624 contracts, if COMEX has to go into the market and buy physical to fulfill delivery, prices will spike immediately. But even if they manage to deliver this round, the precedent is set. The next delivery month is next month, and the month after that. And China isn't stopping. Their industrial demand isn't optional. They need hundreds of millions of ounces annually, and they're not getting it from mine supply. So they'll keep doing exactly what they just did. They'll keep standing for delivery. They'll keep draining registered inventory, month after month, until COMEX breaks. And here's the detail that makes this inevitable: China's fiscal year and infrastructure planning. The Chinese government operates on 5-year plans. The current plan runs through 2025 with massive solar and EV targets that require fulfillment. This isn't discretionary spending that can be delayed. This is national strategic priority backed by political mandates, which means the silver demand from China isn't a trade they can exit. It's a structural requirement. They will pay whatever it takes, and they have the foreign reserves, over $3 trillion to outlast any Western bank trying to defend a paper price. This is why I keep saying $100 is inevitable. It's not because of a chart pattern. It's not because of inflation fears or dollar collapse. It's because the physical market and the paper market are disconnecting. And when that disconnect becomes undeniable, the paper price has to snap upward violently to reflect physical reality. And physical reality is this: there is not enough above-ground silver to meet industrial demand at current prices. The market has been balanced only because paper derivatives created the illusion of unlimited supply. But paper can't build a solar panel, paper can't power an EV, and China doesn't want paper. Let me give you the final calculation that seals this. Total above-ground silver inventory globally, everything in vaults, everything in ETFs, everything in private storage, is estimated at around 2 to 2.5 billion ounces. Sounds like a lot, but annual industrial demand is 900 million ounces and growing. If just 10% of that above-ground stock gets locked up in industrial applications annually, which is conservative given current consumption trends, the available investable supply shrinks by 200 to 250 million ounces per year. At that rate, the liquid silver market becomes illiquid in under 5 years. And prices don't wait for zero inventory. They explode when the market realizes the trajectory. China sees this trajectory. That's why they're not waiting. That's why they're taking delivery now while the price is still suppressed. They're securing physical supply before the rest of the world realizes what's happening. And every ounce they take makes the next ounce harder to find and more expensive to acquire. So when you see 1,724 contracts standing for delivery and you see backwardation confirmed, you're not watching a data point. You're watching the beginning of the end game. You're watching the moment when the paper facade starts to crack. And once it cracks, it doesn't repair, because the underlying shortage is real. The industrial demand is real, and the inventory drawdown is real. This is not a squeeze in the traditional sense where shorts get caught and then cover and the price returns to equilibrium. This is a permanent repricing of silver from a manipulated paper price to a physical scarcity price. And that repricing doesn't happen gradually over years. It happens in violent moves that catch 99% of the market off guard. $100 silver isn't the top. It's the first checkpoint. Because once the paper market breaks, once physical premiums explode, once COMEX either defaults or delivers its last ounce, the price discovery moves to the physical market. And in the physical market, price is determined by what industrial buyers will pay to keep their factories running. What will China pay for the silver they need to hit their solar targets? What will EV manufacturers pay to keep production lines moving? What will electronics companies pay to avoid supply chain shutdowns? A lot more than $100 an ounce. The backward rolling we just saw is the confirmation. The contracts stood for delivery. The metal is being demanded. The inventory is draining. And China is the force behind it with industrial needs that dwarf speculative demand. This isn't about traders betting on higher prices. This is about the world's largest industrial economy securing the raw materials they need to function. And they are doing it at the expense of Western financial markets that built their whole pricing structure on paper promises. If you're holding physical silver, you're holding the asset that the world's second largest economy needs and can't produce domestically. You're holding the asset that every growth industry requires and can't substitute. And you're holding it while the futures market realizes it promised delivery on metal that doesn't exist in the quantities claimed. That's not a trade. That's a transfer of wealth from paper to physical, from west to east, from financial claims to industrial reality. And it's happening right now. The 1,624 contracts that just demanded delivery aren't the end. They're the beginning. The registered inventory will keep bleeding. The delivery demands will keep coming. And the price will keep climbing until it reaches the level where industrial demand destruction occurs or new supply floods the market. Neither is happening at $75. Neither is happening at $100. And by the time the market figures out what level actually clears supply and demand, you'll be watching silver trade at numbers that sound absurd today, but make perfect sense in a world where paper promises couldn't deliver physical metal. The backward rolling is confirmed. The contracts demanded delivery. The inventory is draining, and China is just getting started. $100 silver isn't inevitable because of hope or prediction. It's inevitable because mathematics doesn't care about sentiment. And the math says the physical silver market is about to discover what happens when the biggest industrial buyer in the world decides paper is not good enough anymore. Watch the next delivery month. Watch the registered inventory. And watch what happens when the market realizes that 1,624 contracts wasn't a one-time anomaly. It was the new normal.